Hello, this is the synopsis for Chapter 3 of the Managerial Econ book. And I forgot to mention before, in this book, there are solutions that I will be posting for the homework problems, not the group, not the ones that say group problems, but the ones that say individual problems. There are solutions for. So once once the due date is passed and you all have turned the homework in, I will post the solutions. All right, so in this chapter, I'm going to be pointing you in the right direction of what specific sections I want to make sure you read in the chapter. And then I'm going to be going over the main points of this chapter. So basically what chapter 3 is dealing with is cost benefit analysis. So basically it deals with, any decision that we make, we should be doing some kind of cost benefit analysis. And if the benefits outweigh the costs, then we move forward with that decision. So make sure that you read the coal example. That's a real interesting example on page 25. And then also this Cadbury example on page 27 that deals with employee housing, which is really interesting. All right, so in this chapter, they're talking about implicit costs and explicit costs, and they're talking about accounting profit versus economic profit. So when you think, most of you have, probably all of you have had econ already, the Econ 500. If not, you've had econ as an undergrad. I'm sorry, accounting. You've all had accounting 500, and I've got econ on the brain since I'm teaching econ, obviously. So you've all had accounting 500. Or if not, you have had an accounting class before. So just think back to the income statement. The income statement, you have your sales minus your cost of goods sold, minus your general and selling expenses, administrative expenses, minus all your other expenses. Your bottom line is your net income. So that's called accounting profit. Now, what we're talking about is another type of profit, which is, we're talking about another type of profit, which is economic profit. So accounting profit only includes explicit costs. In other words, the cost that you're actually incurring. However, economic profit includes the implicit costs. And what I mean by that is, let's say, for example, someone has started their own business, and they come, you talk to them a year later or so, and they say, well, I did pretty well for only my first year in business. I have net income of $30,000. And so you think, well, that's great for somebody in their first year of business, maybe, because they're making a profit. They have an accounting profit or net income of 30,000, but for a fact that they gave up a $60,000 job. So if they're not taking a salary, then they really should include their foregone salary as an implicit cost. So they're really not making 30,000 in net income, or they're really not making 30,000 in profit. They're actually losing 30,000 in profit. And so that's what we're talking about with economic profit. They're showing an accounting profit of $30,000. But when you factor in the implicit cost of the foregone salary of $60,000, they actually have an economic loss of negative 30,000, a loss of 30,000. So let's look at another example of what might be included in economic profit. Let's say, for example, that you start your own business. You are taking a salary, but let's just say that you've put 50 grand into the business. Well, that's 50 grand that could have been invested in the stock market or invested in property. So you possibly could have an economic loss, because if you're not making as much money on the business as if your rate of return is not as great on the business on that 50 grand as it would have been if you would put it in another investment like the stock market, then that would be an economic loss. All right, so let me back up here. So we're looking at two different things. We're looking at economic profit, and then we're looking at this economic value added. So let me back up here to the beginning of the chapter. So they're saying here that you do a cost benefit analysis, and firms should only take on a project if the EVA, or the economic value added, is greater than the cost of capital. So obviously you have a cost of capital. Your cost of capital is what, if you've issued bonds, the interest rate on the bonds is your cost of capital. If you've issued stock, the required rate of return on that stock is the cost of capital. If you take a loan, the interest rate that you're paying. And so remember from your prior finance classes, or if you don't remember, don't worry about it, because you'll be learning about this when you take finance in the MBA program. But we calculate something called a weighted average cost of capital. It's a weighted average between the amount, the percentage that the company is getting their capital from bonds, the percentage from debt, and the percentage from equity, basically stocks or bonds. So anyway, the bottom line is the money you're obtaining, this capital, it costs you money. You're not going to take on a project unless you can make a profit. In other words, unless this economic value added is greater than the cost of capital. And so what this chapter is saying is that you can't just look at accounting profit when you're thinking about economic value added. You've got to also take into account the implicit costs, which is what we call economic profit. Economic profit includes the explicit costs that are taken into account with accounting profit, but economic profit also includes the implicit costs. Okay, so hopefully I didn't confuse you too much with trying to explain with my explanation, or trying to explain all that. So let's go over it real quick in the notes here. So economic value added differs from accounting profit because EVA includes the opportunity cost of capital, okay, or these implicit costs. All right, economic profit includes EVA. Economic profit includes implicit costs, not just accounting profit, which only includes the explicit costs. Here's some examples. One example is foregone wages, the example I mentioned before. And so let's say you've got the sole proprietor. They might have foregone wages, or they might have a foregone equity return. So here's an example. Let's say someone leaves a $60,000 a year job, starts their own business. Their accounting profit in the first year of the new business is $50,000. However, they did not take a salary. Therefore, when you account for the implicit costs of the foregone wages, they've actually have an economic loss of $10,000. Another example, as I mentioned before, is the foregone equity return. That's the money you've invested in a business. The implicit cost is the potential return you could make if you would have invested the money somewhere else. So to sum all this up, a firm can have accounting profit and an economic loss because economic profit includes both implicit and explicit costs. All right, now, what are opportunity costs? Well, an opportunity cost is what you give up to pursue another opportunity. It's actually the highest thing that you give up. So in business, let's say, what would be your opportunity cost of starting your own business? Well, that could be the job security that you would have that you might have from a job that you left. Opportunity costs would be, I mean, it's not all financial is the point I'm trying to make. It could be job security. It could be obviously monetary too, wages, benefits, less time with your family because you're trying to start this new business. So it's just, whatever you give up to pursue another opportunity is your opportunity cost. But the strict definition, I just named several things, but the strict definition is the highest thing the most valuable thing that you've given up. So let's say, for example, you're studying for an exam, your friends call you up and say, hey, let's go to Bourbon Street. Let's go down to the French Quarter. So if you stay home and study, what is the opportunity cost? of staying home and studying? Well, having a night out on the town. If you have a night out on the town, then your opportunity cost is the time studying. So it's just what you give up to pursue another opportunity. All right, sunk costs. Sunk costs are costs that have already passed, so they should not be included in the decision-making process. So let's say, for example, you probably remember cash flows when you're taking finance classes. We look at these cash flows and we try to find the present value of the cash flows and so forth to see if a company should take on a project. The net present value, if you will. We're going to actually be talking about net present value, and I think the next chapter, the chapter after that, might be chapter 5, just briefly, because you're going to have that in finance. But anyway, let's say that you're trying to figure out if you should, let's say you have a business in Thibodaux. You're trying to figure out if you should open a new business, a new branch in Homa. And you're looking at this, thinking about this property. And so you're trying to figure out how much you'll make. What will the cash flows be from this? Well, if you did a study, a feasibility, if you did some kind of survey or a feasibility study when you were thinking about moving or opening up this new branch last year, that's a sunk cost. It's not relevant to your decision today as to whether or not to open the business. So that's one example of a sunk cost, something that you've paid for in the past, feasibility study, survey, what have you. Also in the book, they mention an example of a sunk cost would be selling general and administrative expenses. They don't vary with output. So if you are, let's see, if you're, considering selling something or looking at, how much you're potentially going to sell, you're going to have these administrative expenses anyway, these selling general administrative expenses anyway. They're not going to vary with output, so they're considered to be a sunk cost. Okay, now make sure you read about the sunk/fixed cost fallacy. So they talk about the sunk cost fallacy and the fixed cost fallacy when firms, that's when firms take irrelevant costs or benefits into account. Because remember, sunk costs and fixed costs aren't really relevant to your current decision making. All right, so make sure you read that. And then finally, the hidden cost fallacy is when firms ignore relevant costs. Okay, so here's an example that they use in the book of a hidden cost fallacy. For example, when leading up to the whole mortgage meltdown, 2007 to 2009, institutions began writing these subprime mortgages. So remember from the paperback book, the government decided they wanted to increase homeownership in the US. So they started loaning, making it easier for people to get mortgages. So a lot of institutions began writing these subprime mortgages, but they ignored the hidden cost of the higher default rates. So that would be one example. And so, it kind of, this hidden cost fallacy kind of ties in with these unintended consequences that we talked about in several times in the last book. Let's see what else. Oh, a current example that comes to mind. I have relatives who live in California. I'm from San Diego, and I still have people living out there, and it's crazy out in California. It really is true. People are nuts out there. So I'm talking to my mother, and my sister lives in this town of Temecula. It's a fairly big city now. It's a bedroom community north of San Diego. Well, it's its own community. Anyway, here's the point I'm making with this. It's a hidden cost fallacy. This is the craziest thing I've ever heard of. So Temecula has instituted this program where they're making people put their food waste in separate receptacles. Okay, so you've got your paper, whatever, your recycling, you've got your paper and your plastic. And now whatever you don't put down your garbage disposal, anything that's food, they're making them put in these separate containers. However, in their infinite wisdom, they've decided that they're not going to pick up the food waste except every 2 weeks. So they have all this food waste. They're only picking it up every 2 weeks. So guess what happens? Now they've got rats and all these rodents and pests coming into Temecula because food's sitting around for a whole week, for 2 weeks, plus the smell and everything else. So I'll end this synopsis on that note that the city in California has their hidden cost fallacy is they were trying to be more environmentally friendly by having people separate their food waste, but they decided to save money and only pick up twice a week, or excuse me, only pick up every other week. And so now they've got the hidden cost of trying to put rat traps out or rat poison and try to kill the rodents. So that's my hidden cost fallacy example of the day there. Okay, so I just went over the main points. Make sure those are the main takeaways for chapter 3. Make sure you understand economic value added, implicit costs, explicit costs, economic profit, and accounting profit, sunk costs, opportunity costs, sunk cost fallacy, hidden cost fallacy, and then that's it. All right, so this is that now you've got, after you do this, look at this synopsis, then you'll have everything that you need to go ahead and do the first homework assignment, which is chapters 1 through 3. All right, until next time, goodbye.